Okay, so welcome everyone who's from from snowy Boston. I guess welcome. Hopefully it's sunny over there in Orange County. And so my name is York Lowe. I'm the head of alternative product at John Hancock Investment Management, and I'm extremely honored to be moderating and hosting this session today to talk about alternative assets. And with four esteemed colleagues of mine. Of course, alternative assets is something that we can spend a lot of time on. We only have an hour, so we kind of narrow it down to two relatively unique strategies that we will spend a little more time on, namely asset-based lending in the private credit side, and then also timber and AC in the real assets side. But just want to set the stage, I guess, where we're coming from here. So my group, myself, I actually have 25 years. Actually, this year is my 25th year in the industry. So we've gone through a few major cycles, if you will, and for the past 20 years of that, I actually been a KAYA, another friendly association to CFA, charter holder, and been talking about alternative for a long time. But I think the two first major drawdown in the markets that we've seen, namely the bursting of the dot-com bubble in early 2000s, and then of course the GFC in 2008. I guess we lots of people interested in alts, but then still, if you have a 60-40 portfolio, right, your fixed income has been able to help you. But I guess the interesting thing is in 2022 is probably the first time, and it's not just in the 25 years I've been around, but in actually the study that's been done that over the past since 1878, the 10 major drawdown in terms of calendar year, this is the only time where a fixed income has not helped a 60-40 portfolio. So a lot of people are really seriously giving some thoughts about adding more, whether it's alternative investment strategies. So if we have time, down the road, and people like these kind of panel, we can certainly talk more about alternative investment strategies using whether it's long short equity and other type of strategies, or really alternative assets, right? Buying private equity, credit, real assets, and other true alternative assets. So that really becomes very interesting. And in terms of John Hancock, we have been, kind of adding alts to our allocation for a long time. I think if you look at the fund of funds that JHIM, which I'm part of, we have added a lot of liquid alts over the past 15 years. That has helped our portfolio. And then, of course, in our general account side, as an insurance company, we have been investing in many of the private equity managers, and been doing real estate and private other real assets investments for for decades. So I think I'm very honored today that we are able to bring, we have an open architecture, so half of our assets, for example, are with 30 different managers. So I'm very glad that we were able to have both our sister company, Manulife Investment Management, and also another investment partners of ours, Marathon Asset Management, to talk about their background, their asset class. And then I guess, if you have questions along the way, you can certainly put them in the chat, and then, but we will answer them towards, in the second half. But the first half of this presentation, I guess we will basically have each group go through a little bit of their background, a little bit more on their strategy, and then I will have some kind of panel discussion questions, and then we'll open it up to the general to the audience. So with that, I will pass the mic to, I guess, Jonathan Glass and Ed Kong from Marathon Asset Management to talk more about the firm, and also private credit, specifically, I guess, asset-based lending. So John or Ed?
Thank you. Good afternoon, everyone from New York. Jonathan Glass here, a director on Marathon's business development team, and joined by my colleague Ed Kong, who's a portfolio manager overseeing our asset-based and structured credit business at Marathon. But also, it's great to be, with my fellow panelists over at Manulife and John Hancock as well. And thanks to everyone for carving out a few minutes. I know it's a busy start to the year to speak with us. And so, what we're talking about today in our partnership with John Hancock is really a part of the private credit market that is very large and starting to get a lot of attention. And that's asset-based lending, specialty finance. And maybe before I jump into that, I'll just spend a minute or two on Marathon, and we could sort of go from there. Marathon is about a $23 billion global credit manager. We were founded in 1998 by Bruce Richards and Lou Hanover. They are, still currently the CEO and CIO of the firm. We have about 160 professionals globally, offices. Our headquarters are here in New York City. We're in London, we're in Tokyo, Luxembourg, Miami, Los Angeles. 9 partners that have worked together for an average of 18 years. Our 10th partner is Blackstone. In 2016, they purchased a minority non-control stake in our business. We have a very diverse client base, ranging from public pensions to sovereign wealth funds to endowments, foundations, and high net worth. And really, our core skill set is global asset management, sourcing, financial and operational restructuring. We are a market and cycle tested team that is the incumbent in asset-based lending. But maybe, first I'll just, focus on sort of what the food groups are in terms of the global credit focus that we have. And it's really everything from the top left at corporate credit, performing, stress, distressed, high yield, you name it. It's emerging market, hard currency. It's liquid securitized credit, RMBS, CMBS, CLOs, ABS. Marathon was tapped and selected by the U.S. Treasury back, during the greater financial crisis to help facilitate pricing discovery in the mortgage-backed securities market. We're the top performing manager. We focus on commercial and residential real estate and also asset-based lending, which is really.
So, John, if you don't mind, I want to pause. I'm not
Please.
seeing the slide moving, so I don't know if you are referring to a certain
I'm
diagram.
still on this. I'm still on this slide.
Okay, good.
Okay.
But I was seeing the first page before, but yeah. So.
Oh, apologies there. Hopefully you can see this slide. So yes, we're global credit firm focused on a variety of strategies that encompass alternative credit, and asset-based lending is a big focus of ours, where we've invested north of $20 billion of capital since the firm's inception in 1998. Hopefully everyone can see this roadmap slide. Great. So I think the traditional view of private credit is really that of one or two strategies. It's direct lending, which is, the foundation of a lot of private credit, portfolios, and depending on where you are in a market cycle, it could be mezz or distressed. But it really is a diverse mosaic of strategies, and diversification of varying kinds can really be found and exploited within private credit allocations. And you've seen private middle market direct lending obviously grow from a cottage industry to about $500 billion today. And the broader private markets are about $1.2 trillion. Our view is that asset-based lending specialty finance really provides clients with differentiated credit exposure that's meant to be more resilient and less correlated across economic cycles. So it's really a yield enhancer, and one in which you include it in your private credit portfolio. It creates a core plus allocation. And so the main takeaway is that by some estimates, asset-based specialty finance is a $4 trillion industry. So, north of 4 times larger than middle market direct lending. And it really is deserving of a place in a private credit portfolio. From there, maybe I'll just sort of give you a sense of scale and pass it along to my colleague, Ed Kong, and he could sort of talk through the different, strategies, provide a quick description, and just sort of give you a sense of the overall addressable market.
Great, thank you, John, and thank you, York. Yeah, so I'll just make some additional comments to what John was, mentioning about asset-based lending. And, I think our belief really is that asset-based lending is, for all intents and purposes, really coming of age, really, as a through cycle investment opportunity. And it's really focused on, the dividing line is assets, underlying, hard assets. And certainly in a investment environment that is a bit uncertain right now as it relates to inflation and rates, we want to focus on the quality assets and kind of strong recovery values. So just think about a profile, generally speaking, driven by strong cash flows, senior loans backed by hard assets, and so a large margin of safety. And as John mentioned, it's a multi-trillion-dollar sector. And the way we think about it at Marathon here is, we have a pretty broad mosaic of strategies, a little bit more, kind of winnowed down from the previous slide that John mentioned, but still we estimate about $1.6 trillion of opportunities. And it's a global program that we run here at Marathon. It includes the origination acquisition of real estate loans, both commercial and residential. It includes asset-based healthcare finance, FDA-approved therapeutics only. It includes transportation lending and leasing, with a particular focus on mid-life narrow-body planes like the Airbus A320, asset-based corporate lending as well, and then consumer loans. So a really well-diversified program. And we think that diversification is actually a really important and key tenet of, sort of that uncorrelated return that John was just mentioning. Turn it back to you.
Yeah, and you mentioned uncorrelated returns, and you mentioned potential benefit in an inflationary environment. Maybe you can also speak to just some of the other portfolio benefits that you see here on the page, or any that really stick out to you, Ed, as you're sort of thinking about underwriting and originating, transactions.
Yeah, I think a lot of it has to, really has to do with the asset, right? When we think about, the key to our program is understanding asset valuation. And I think the key approach to an inflationary environment, and possibly an inflationary environment where there could be slower growth, is that you want to be backed by productive assets, right? And so it's about the scarcity of assets. It's about customized, sort of structuring. It's about the cash flows coming off of those assets. And it's about, for us, when we think about, sort of entering possibly a slower growth environment, it's about us being able to, basically get those assets back, right? And the reason that that's so important is because, why do you go to private assets? You go to private assets why do you give up that liquidity? You do it because you want more control, right? So you get that control, you can get that asset back, and therefore you can basically optimize and increase your recovery value. So between that and the cash flows, you basically, altogether, you have a really nice package where, for all intents and purposes, you have an optimal Sharpe ratio, right? So I think that's really those are some of the key tenets to our program. John, I'm not sure if you have anything to add there.
No, I think that's really well said. I think, when you contrast it to the middle market direct lending space, which is obviously a fantastic and, stable, portion of an alternative credit portfolio, I think a big driver of the return premium and what we do is that, these assets are typically harder to source, harder to originate, harder to understand. And I think because of this, there's really less capital chasing these opportunities. And it really does provide that diversification, stronger risk-adjusted returns, and, some downside protection. So again, creating a core plus portfolio when you do exploit this fuller opportunity set. And those are the prepared remarks that we have. I'm not sure if York has any direct questions for us, or if we should pass it along to our
I think
friends at Manulife.
We can certainly discuss more during the panel discussion, but I'll now pass it on to, I guess, Matt Gallo and Alex Catterick from Manulife Investment Management to talk more about the background of the firm, and also, I guess, specifically timber ag would be the focus. So Matt or Alex.
Great, and thanks again, York. And it's a pleasure to be presenting in front of this forum today. Just as background, my name is Matt Gallo. I'm based in our private markets organization and running our product development and business development initiatives for really focused on our private wealth and high net worth client segment. I'm joined here by Alex Catterick, who heads out our private markets high net worth strategy division. That's again leaning into a lot democratizing or expanding our private markets capabilities into that private wealth channel. I'll just step back, and in York, you mentioned it. At its core, Manulife is an insurance company. Underneath that, we have an investment management arm, and then within that, we have an integrated private markets business. On the screen here, you can see, we invest, and we've been investing on behalf of our general account or our balance sheet for over 95 years, and it's across the spectrum of asset classes, from real assets to private equity and credit. To date, our portfolio that we manage is roughly about 120 billion in assets. And again, the evolution of our overall private markets platform has evolved from managing assets primarily for our GA to now getting to more investor segments. So institutional, CIO, and then a big push now is into our private wealth and high net worth client segment. Real assets really represents a core foundation for our private markets platform. We have a strong allocation, built out team, and a proven track record in that portion of our private markets platform. And that includes, again, you can see on the screen here, everything from real estate, timber and ag, infrastructure, and et cetera. Focusing on timber and ag, which we'll dive in a little bit more in today's call. We've been managing timber and ag assets for over 35 years, again, starting really for their general account or our parent company, and then growing that into our focus on our third-party business. To date, we manage just shy of 15 billion in assets on a global basis, and that includes both our timber and ag segments under that. We really have a robust team that is integrated into this asset class, from property management, investment management, research, acquisitions, boots on the ground folks that are monitoring and assessing the land. And it really reflects sort of some key metrics about our business. We are the largest timber manager globally and the second largest ag manager. And that's based on owning and operating these assets directly. I'll stop here and actually just pass over to Alex. Alex will dive a little bit more into the asset class specific and in respective characteristics and how this asset class has been picked up and fits into a client portfolio.
Thanks, Matt. That's a great intro. And we're finding a greater amount of interest in the asset class, and we particularly, we're not surprised to see that, given the market volatility that we've withstood over really the past 12 or 18 months, as I'm sure as everyone aware. And given the inflationary pressures and interest rate environment that we've had, timberland and farmland has historically exhibited positive correlation with inflation. We can talk about that a little bit. But where I like to always start this conversation, because there are a lot of folks that are aware of timber and farmland, but don't exactly know how to think about it. I like to think about it first like real estate. And if you think about real estate, real estate is a long-lived asset. Real estate typically throws off some sort of cash flow, and typically it's a property that you can improve. And timberland and farmland have similar characteristics to that, in that they're very long-lived. Location matters and the asset quality matters, but you can improve the asset and improve the cash flow that comes out of that. And you can see on this page that, not surprisingly, farmland and timberland actually, scores well when you look at returns and risk profile in terms of the volatility that the asset class exhibits and the returns that we've been able to generate from both timber and farm over the past 30 years or so. But essentially, at the end of the day, what we're thinking about is these are assets that are planted, they're harvested, they're sold, and they yield sustainable food, fiber, and shelter. And the different types of timber and farm that we have available, and maybe you can move to that other slide, just the one other slide that we wanted to look at, is the way to think about it is, timberland typically exhibits returns in the 10 to 12, it says 10 to 16 here on the page, but really core timberland holdings really trend towards more of a 10% return. Timberland and farmland plus is where you get that higher return. And then on the agriculture side, you've got permanent crops and row crops. And row crops are typically, things that are planted on an annual basis. If you think corn, soybeans, wheat, where you're actually working the land and producing that yield, producing that product and selling that into the market. And typically what happens there is, that's typically a yield play, where you're looking to generate those cash flow returns. And then permanent crops are things that exist like, trees and vines. So if you think about, almond plantations, if you think of apple trees and apple orchards, if you think of vineyards and grapes, those tend to be permanent crops. And then if you think of, timber, we have, different regions around the country where you get softwood versus hardwood, and you can expand that around the world, obviously. And you've got different uses for that. And as we kind of work through the cycle of timber versus ag, one of the things that we've recommended to our clients and our investors is you really want to be able to access both of these strategies and be able to have a balanced portfolio between the two. Because if you look at the returns and deconstruct them over time, typically by combining a portfolio of timber and farmland assets, it smooths out the overall returns and gives you a more consistent return stream and much lower volatility. And it does lower that correlation to other financial assets like equities and fixed income. And then maybe the last thing I would just touch on, and would love to maybe then open it up to some of York's questions and have, questions from the group, is just if we think about the tailwinds that we're seeing both for timber and ag, because we have seen a much increased interest in the asset class, partially from interest around sustainability and ESG investing. And one of the big things that both timber and ag are known for is they're very good at carbon sequestration. Just by their very nature, they absorb carbon from the air and from the environment. So that's been something that our team is very mindful of managing. Then additionally, if you look at the actual yields that come off of these two different types of products, these lands. So if you look at timber, obviously you've got, home building. There's been an increased use of wood products as opposed to concrete and steel for housing. That continues to be a shift that takes place. We did see, as we headed into the COVID environment, there was a big shift on home improvement. A lot of folks are working from home. There was a lot of new build as people moved out of cities and moved into suburban settings. We think that's a trend that's going to continue longer term, and we, will continue to see, I think, demand for wood products and timber. On the farmland side, farmland's becoming increasingly global. And as we see improving diets, in China and India with emerging middle classes, as we see demand for better diets, we also saw this through COVID. People wanted to eat more healthy. And if you want to be able to find pistachios, for example, that's a crop that only grows in certain regions around the world. But as you see this increased demand for better diets, and as you see, this increasing demand from these emerging economies, we think these high value products will continue to have, strong demand. So we think the drivers both on the timber side and on the farmland side are positive long term. And again, we like to point to the fact that this is non-correlated to traditional equity and fixed income, and does provide returns. If you aggregate them all together, typically you're looking at an 8 to 10% total return with maybe a 3% cash yield, which isn't as exciting as what our colleagues over at Marathon can produce on a cash flow basis. But we do think it's a great part for, folks' portfolios. So I'll stop there. I think York has some questions that we want to be able to run through, and then we'd love to open it up to the broader group.
Thank you, Alex. So, and I guess you brought up a topic that maybe John can also address too, and I'm sure some people would ask, is in terms of returns and risk return profile for asset-based lending. Do you want to elaborate a little bit more on that in terms of John?
Absolutely. Sorry about that. When you think about the return profile, overall, you could think about it more of sort of the 80-20 rule, where it's, primarily an income-driven total return solution with, primarily self-amortizing, investments that are generating very, heady yields. And so when you think about an overall portfolio perspective, it could be, total returns ranging from 10 to 12%. And if you think about it on a multiple on invested capital basis, around 1.5 times on a net basis.
Okay. So I'm going to dive into kind of the first panel discussion question. I guess a lot of folks are kind of grappling with this, right? Because most of us, probably have public liquid securities, stocks and bonds in our portfolio. And so essentially your strategy is kind of the private version of that. And historically, for example, some folks are buying these because they're higher. The private version is higher yielding, but with the recent market disruption, some of the high yield and bank loan funds or ETFs are actually pretty high yielding. So can you talk about what is the benefit of buying private right now? I guess address both to Marathon, also to Alex, in terms of real assets in general. I guess most people buy REITs. I mean, there's not too many public timber farmland options. I mean, certainly there's some paper companies and some, but maybe you can address that from a real asset, a REIT kind of angle also.
John, you want to go first
John,
on the credit side?
Maybe I can step in.
Yep.
Yeah, I can step in. So
Sure.
So I think in some ways I almost view it as not a public versus private debate. I actually think the public markets inform the private market pricing. I think it just takes some time. And so when you have big bouts of volatility like you saw in 2022, obviously the public markets adjust. They adjust from a credit investor standpoint, underlying rates are higher, credit spreads are higher. You want to price in more recessionary scenarios. So those yields go up. But then the private markets just take a little bit more time. It could be 2, 3, 4 quarters, and then they adjust. And there will continue to be a private market liquidity increase in terms of yields. I think that's actually going to be persistent. And so I think the way to sort of think about it is that the public markets adjust quicker, and then what they tend to do is they'll settle down, right? Credit spreads will settle down, bond market volatility will settle down, volatility overall will settle down. And the private markets, I would say, for our program, we've been very patient. We actually take cues from public markets. So we're waiting for 3, 4 quarters for those yields to actually correct. And so I think we're actually back to the point where the private markets are offering more yield than the public markets. And I think that gap is actually, it's very secular. I don't think that's going to change. So.
Yeah, so if people are looking for a smoother ride, right, that's kind of the private credit really provides that.
Correct.
Yep. John, you have.
Yeah, I was just going to say that I totally agree with Ed. I think that what we're doing in the private space is really less influenced by central bank liquidity, and it's really a diversification of asset classes where quality can really be controlled, and there's a lot of flexibility to sort of work through and manage assets in the case of private assets.
Okay, and then Alex or Matt, do you want to address in terms of?
I'll start, and Matt, you can always jump in. If I look at true timber and farmland, it historically has been an institutional asset class, right? So if you actually wanted to own a farm or you want to own a plantation, typically that's been the realm of institutional investors. And for folks that want to be able to access it through some sort of proxy, historically you could buy various equities that were tangentially or even directly involved in the timber and farmland space, right? The names that come to mind, John Deere or Agrium or Cargill, and then as York mentioned, there are some very specific REITs that are either timber or ag focused. In all of those cases, if you compare what we're doing and the notion of owning the direct these direct assets on a private basis, you really X out the volatility. If you look at the timber REITs this past year, they traded much more like equities than they did trade like the way that we value our properties. So the volatility is certainly one part of it, and the correlation, and that's really the part here is that we're looking to own these assets for I don't want to say perpetually, right? Because we do make sales. We do think of best use of land. But typically we've got a 10 or 15 or 20 or 25-year time horizon, which is typically the life of the asset in terms of the way that we work it. And again, we're really trying to drive that long-term return. So I think it really is a different mindset. And if you want to have that real private asset feel, if you want to get the real return stream that you're going to get from the underlying asset, investing in it directly, which is the way that we do it, and managing the properties as we do, because as Matt mentioned, we have an integrated business that is actually working all of these properties on a direct basis, not just valuing, investing them, valuing them, and disposing of them. We're actually working the land and producing these returns. So I do think it is a different outcome and a different approach to investing.
Okay. So I guess moving to another topic that's on a lot of investors' mind right now, and of course, today we have the inflation number that came out, 6.5%, which is cooler than what people think, but then it's still kind of a high number. So I guess in this high inflation environment, and probably will remain high interest rate environment, how does the respective asset class perform? If you can, I mean, maybe start with John and Ed first.
Yep. So maybe I'll start. So what I can say about I'll just go back to when you're asset based, right? I think Alex and Matt had mentioned that sort of timber is a good hedge against inflation. I think generally speaking, on the asset based side, when you think about the different strategies that we're involved in, if you have a scarce asset where you've properly assessed the supply demand dynamics of the asset, whether it is hard to access those assets, where you can think about resetting rents, on a go forward basis. I think those are that's basically why we think asset-based lending is a great place to be in an environment like this, right? Is because you have that ability to basically increase your cash flows. And I'll just give you one example where we're leaning today. We're actually in our overall program, we're actually leaning a little bit more into aviation lending aviation leasing, excuse me. And so with aviation leasing, you're sort of in this situation where travel, obviously, there was a timeout on travel. There was, some issues with Russia, Ukraine, and international travel. But all of a sudden now, what's driving some, the underlying inflation that you just quoted, New York, is, travel and leisure is bouncing back. And, the fact of the matter is that, Boeing and Airbus, they're having, a hard time with their, deliveries, right? So it's actually, that's a scarce asset where we can actually reset the rents on an active basis. And we think that's just a, great place to be right now. And then to the extent that we have to take an asset back, just as Alex said, you want control of the asset, and we have the ability to basically, kind of really maximize our recoveries if something goes sideways with our assets, our investments.
And
Okay.
and York, on the timber and ag side, so historically, ag has had a positive correlation with inflation, and then timber maybe less so, and I can maybe talk about some slight nuances there. But if you think on the ag side, and we saw this in play through the last year, and any of us that have walked through a grocery store, this year, food prices are up, right? So in the case of ag, you can typically pass on inflation, and it ends up being absorbed by the consumer because all of us need to eat. You might see switching costs, and then that maybe flows through to the way that the farms actually manage their own crops and yields, and you can swap out crops year to year. But essentially what the farmers are dealing with is they're dealing with higher input costs, so higher labor, higher fuel, higher fertilizer. That typically gets passed on into the higher crop prices, and then the consumer ends up having to absorb it. And hopefully what happens is they don't have to make too many hard switching decisions over time, and that inflation ultimately comes down. But that's typically the way that it goes. And on the timber side, typically you can actually stall buys, right? Like you can slow down new home starts. You can pass along a lot of the pricing at the sawmill for the timber and for the logs. But what ends up happening is you can see a reaction in terms of actually the new build. So that typically adjusts. So the correlation isn't as good, or the ability to pass on prices isn't quite as robust on the timber side as on the ag side, but they are both positively correlated. And we have seen that typically having a 50-50-ish allocation to both the timber and the ag asset classes in an inflationary period, it does protect you.
So I guess, Alex, maybe drill down a little bit more. I guess a related question some of the audience might have is, I think the the huge volatility in some of the commodity prices, does that impact your strategy at all? Like in terms of all the soybeans or whatever, I don't.
Sorry, you're asking
lumber price, yeah.
So it doesn't change it doesn't change it might change the way that we manage some of our properties, right? So where you see switches from one commodity to one farming commodity to another, right? If we're able to get a higher return from soy than we are from corn, you have the option to switch out those crops kind of year on year, right? And that's part of the thing that we're doing on an active managed basis in terms of working with our farms. On the timber side, you can actually choose not to cut, right? I mean, remember, the trees are growing, right? And there's value in the tree. So if in a given year, lumber prices have dropped off because, there's been a slow in, people going to Home Depot and buying, 2x4s to rebuild their garage, right? That actually happened this year. Folks put, home improvement to the side. We can choose not to cut. And we can choose to allow the value of those tree lots to improve, to increase, and wait for the environment to improve for better pricing.
York, and just to add to that, York, so as Alex also mentioned, the input costs have increased, but also it's offset by the output costs also increasing as well. So it's almost like a flat effect, if not the overall price impact for our crops has kind of remained flat in this time period, right? So it's the inputs costs have increased, but overall we've been able to kind of been able to go over that hurdle with output costs being where they're at for crops. And also there's different segments of our timber business that have also seen development efforts as well. Like we're seeing, as Alex also mentioned, timber being used in non-residential high-rise buildings, and that's competing pricing with concrete and steel as a replacement for that. So there's other avenues that we're exploring as well with timber development.
And I guess moving to my next question, I think there's also some people concerned about as we enter 2023, there could be recession, more of a recessional force globally. So maybe Ed or John can talk about how does that impact your strategy, or could it be actually opportunity too for you guys in some case? And I guess then we can go to Alex and Matt.
Yeah, I think that it does present opportunity for us. And when you think about recession in the context of a higher rate regime and higher inflationary pressures, I think that's in some ways that's even better for us. And this is the way I think about it, is that that's the reason you want to run a diversified program, because I think those various the recessionary impacts, the inflationary impacts, they sort of impact our underlying strategies in different ways and sort of at different paces. And so when I think about, hey, the aircraft strategy has been, a little bit more impacted by the events of the last few years. We're going to lean into that because the competition is going to be lesser. Meanwhile, I think other strategies, namely, kind of the real estate, lending side of the picture, they take a little bit longer to adjust to, sort of the new global environment. And so we don't have to deploy capital there, right? So we work on certain sectors, 2 or 3 at any given time, and some of the others take longer to reset. I think overall, when I think about recession, it's just a matter of pricing. I think what we want to do is basically just take a forward look and price in that sort of recessionary scenario. The sector that we invest in that's probably most impacted by recession would be consumer loans. And when I take a look at that sector and what happened through 2022 with basically the federal rate, Federal Reserve hiking to 4% from 0, a lot of the competition actually faded away. The capital market volatility actually pushed a lot of our competitors out of the market. The previously very loose credit underwriting that was associated with things like VC funding, that all actually got washed out. And so counterintuitively, it's actually a better time today to be a consumer lender. And we're pricing our loans to 2 to 4% increase in unemployment. And so you can, so again, it's all about pricing, and you want to have a flexible framework in this environment.
Okay. Alex and Matt, you want to add to this too, or?
I think I have a less good answer than Ed. I think the folks at Marathon have the ability to be way more nimble in terms of managing through different types of environments, and as they move through recession, they might see more opportunities, and they're working amongst different strategies, and they can be selective. For us, I don't want to say we're insulated from recession, because that's not what I'm trying to say, but we're less impacted, right? These really are long dated assets. It's really about how do we manage them for the best outcome and best yield that we have in the current environment. Some of the things I said previously around switching crops to be best suited, or switching land use to be able to have the best yields, trying to manage these farms and manage these timber properties to reduce our cost inputs where we can, making good decisions around when to harvest and when to not. Those are all decisions that we would make at the operating level. When we think of actually making new investments, if you do see a recessionary environment, and that ultimately does have a, increase on or an impact on pricing, we would obviously try and, take advantage of that where as possible. But when you think of the way that we underwrite these properties and the amount of time it takes for us to actually close on a deal, it might take us, 6 or 12 months from the start of when we see something to when we close on it. So, again, I think that's just less directly impacted by broader recessionary environments, unless we were into a very long-term recession. I think, I think my view might be a little bit different. I think a lot of pundits, for what that's worth, are calling for, a short recession, a quarter or two or three, and then we start to normalize. So we tend to look past that just by the nature of the asset class.
Okay. And I guess another question is, I guess the past, definitely past couple of years, lots of assets has been raised in private equity, private real asset, and also private credit. And some people were saying, well, there's too much money flowing, chasing a lot of, kind of few deals and compressing returns in some cases, right? Also, so are you seeing that in the respective strategies that you're in? So I don't know, Ed and John.
Yeah, I mean, I think it's sort of sector by sector. I would say, generally speaking, that in 2022, from as I look at it, beginning versus end, across our strategies, I think there was less competition. I think a lot of that relates to basically the financing markets, and I think sort of the volatility that washed out some of the sort of tourists, if you will, and that had just raised capital to deploy. I think that I will fall back and reiterate a point that John made, which is, I think, the reason that we set up our program to, kind of focus on some of these large sectors is that we can sort of focus on niches where there actually are inefficiencies, where there is some, good level of sort of barrier, if you will, or, kind of barrier to entry. And so if we're looking at a, seasoned pool of residential mortgages that are 15 years seasoned, then we have a specialization in understanding the documents and basically filling in the blanks on data. That's something that's not really so approachable, even when capital is being raised at a high clip, right? So really the key for our program is really to try to get to those opportunities more so than the more crowded opportunities.
Okay, and then Alex and Matt.
Yeah, I think less so for us. I don't think there's been much capital raised for the timber and farmland space. We're the #1 manager of timberland, and we run, $10 or $11 billion. I feel like I saw a number recently that the size of the timberland market globally is, it might have been $2 trillion. Like it's a big number. That might have been the ag number. We see these numbers all the time, right? Where you try and look at the total addressable market.
Right.
It's a much bigger number than the institutional capital has been raised. There's still a lot of private, mom and pop owned farms and mom and pop owned timber assets. There is increasing institutional interest, and it's an asset class that continues to, attract flows. But I think the size of the capital raised versus the size of the market is not experiencing some of those, issues around dry powder that you might have seen in private equity and other parts of the asset class.
Okay, thank you. So with that, I guess I will open up to Mo. I guess there are some audience questions.
Thank you, York. As a reminder, please submit your questions through the chat function. Additionally, if you'd like to unmute or ask your question live on video, that option is available as well. First question we have, York, is around funding. Where are you seeing investors fund allocations into these asset classes from? Is it stocks, bonds, or a combination of both?
So I would, pass it on to Ed and John first, perhaps, and then we can also. Wait.
John, you want to take a shot at that?
Yeah, I think that's a great question. We definitely get it all the time. I think if you looked, X number of years ago, the private allocation, from a credit perspective, was really funded from private equity. I think today, York made some opening comments about the performance of the 60/40 portfolio. I think you've seen some interesting research pieces come out that we would agree with around rethinking that portfolio and thinking about the prospect and advocate for a 40-30-30 portfolio construction model. And really that 30 being a combination of alternative strategies, some of which that we spoke about today. So to directly answer your question, it was being funded by private equity. Asset allocations have matured. Obviously, depending on who you are as a whether you're institutional or high net worth, your allocation also will be different. But today we're seeing more and more of that alternative allocation being funded from their traditional bucket.
And hey, Matt, for the timber and farm, do you want to maybe take that?
Yeah, sure thing. And so York or Mo, what we've normally seen is it's really a fixed income replacement. We're seeing a lot of clients allocating timber and ag as a replacement of fixed income. It serves as a nice diversifying portion to their portfolio. Again, natural inflation hedge. It's spitting out a steady coupon or cash yield, and really again just serves as that stable allocation to your portfolio.
Okay, thank you. Mo, are we seeing other questions from the audience?
Thank you all. The next question is, how has the rising yield environment in public debt affected private credit yields, specifically in asset-based lending? And does the same environment have an effect on timber and farmland?
Yeah, I think I'll start on the asset-based lending side. So the direct impact so far has been across our strategies. We're seeing returns on asset about 300 to 500 basis points higher, and I actually think that's kind of applicable across the board. I think when you think about any sort of investment strategy on a leverage basis, kind of the cost of financing has actually increased by almost the same amount. So I think that that is kind of the biggest impact when you think about the whole spectrum. It's the asset side is increasing yield, the debt side is increasing yield, and so I think kind of going forward, that's where the opportunity is that the returns on asset, you just have to use less leverage now to achieve your hurdles, and you can tighten up underwriting standards and sort of get that security that we've been talking about, and as a reason to get into private alternative assets.
And then on the timber and ag side, if I'm truthful, I would say that the impact has been far less, right? So as you've seen interest rates go up, we haven't necessarily seen the cash yields from these properties go up, right? There's not necessarily that direct correlation, because at the end of the day, timber and farm is not interest rate sensitive. It's not fixed income. We talk about it as a replacement, but it doesn't have the same characteristics as a bond. So really what it comes down to is, over time, in an inflationary environment, are you able to raise your overall cash flow from these individual properties? And that's a longer transition that you would try and put into place, again, around some of the active management that we had mentioned. But no, I would say the yields and cash flows from these properties tend to be a little stickier and not interest rate sensitive.
Okay. So one other question I have is in terms of kind of ESG and impact. I guess some people, are saying that, in the private side actually is more, certainly we have seen almost everyone has integrated ESG into their public, stocks and bonds investments process, but actually private side, actually you have created a bigger impact. So just wondering if John and Ed can elaborate, is that actually incorporated into your private credit selection? Maybe some of your strategies, are they actually creating ESG impact? And then, of course, I think Alex, you touched a little bit on, in your presentation about that, but certainly can drill in a little bit more. So.
Yeah, sure. I mean, so York, ESG is certainly integrated into our process. It's part of our pipeline decisioning process. It's a core part of our investment committee process. And when I think about ESG, I do think that it's very well aligned with asset-based lending, and the reason is just going again, we're trying to focus on scarce assets, right? And so the key to a long-term productive asset is does it have the latest technology, right? Are you able to reset the rents? And so whether on the transportation side, kind of looking at the newest technology, aircraft. If we get involved on, on the shipping side, kind of the scrubbing technology that, is sort of the newest technology is very important actually for the ability to reset rents. And I also think for the lending programs that we run, we actually, our program is sort of stepping in from a lending perspective where the banks leave off. And so a lot of times we're actually providing credit to, effectively underserved borrowers. And so, it applies across the residential, commercial, consumer sectors. And so we're almost a bridge, right? We're kind of a bridge for, those customers, those borrowers to kind of get to the higher credit score, to kind of get to those government sponsored programs where they can get the lowest rate. So I think there, we're not obviously not involved in any sort of usury lending or higher APR lending. We're sort of focused on that credit improvement. So I think those are, a couple examples of how ESG filters into our program.
Okay.
And just yeah, I mentioned it a little bit at the outset. When you think of climate change and nature loss and water scarcity and rising kind of rural inequality, a lot of what we do in the timber and farmland space touches all those, I think, in a positive way. Again, the natural carbon sequestration aspect of timber, the idea of ag, really combating nature loss as we continue to grow more farms. As you have more farms, that's contributing to expanding nature, which we're part of a key component of ESG. And then water is a really important input into all of our processes, and that's something we've been very mindful of. There's a lot of ag tech science that goes into reducing our water usage, but expanding our yields. And that's something that we've done and we've won awards for. So it's something that's been front and center for us. We do think that we're ESG focused and ESG forward, and it's an asset class that by its very nature, makes it an impact and sustainable investment. Matt, anything I missed there?
No, that's exactly it. It's fully integrated, York, from due diligence, acquisition, management of the assets, all the way across the spectrum of our portfolio. And then we're leading in industry standards too, like PRI. And
And in fact, you have some clients who are doing kind of impact first type of mandates too, I believe.
Correct. Yeah.
Over return. So
yeah, absolutely.
Okay. So Mo, I think you have some more questions.
Yes, York, we do. We have another audience question. Can each team speak to a recent investment or deal and some of the characteristics of each?
So maybe Ed can start.
Yeah, sure. Let me think. Okay, so yeah, one interesting deal that we actually just signed up was actually a loan that we did against one of the most in-demand aircraft engines in the world. And it's an engine that basically, and it's a new engine that services the Airbus A320 family. And this is basically something that was sourced through our relationships. And it was fascinating because it was basically an engine that, and these are engines that kind of $10 million type of engines. And the value for this engine, the purchase price, actually struck during COVID. And so there was a little bit of urgency for kind of closing this loan on behalf of the purchaser. And so we were able to structure a loan where we basically lent a little under $6 million against a $10 million engine, so very well covered. And we were able to charge a 13% interest rate on that that particular loan. And so that particular engine is one that we feel like is very releasable, but it will be leased out to a flag carrier in developed market. And so that's just an example of where you can, if you have the ability to understand the asset valuation and also to step in a timely basis to provide a asset-based solution for a borrower, you can basically extract an above market yield that's very well protected. I'll turn it over to Alex or Matt.
Hey, Matt, can you go? My Zoom is not, I don't know if you guys can see me.
Yep, we can see it.
Okay, well, my Zoom's a little funky. So we have been looking at a property in California that is a mixed use ag property. So it is a mix of some citrus assets, as well as I want to say it was almonds, pistachios, and there might have been there might have been cherries on that. So it's a mixed use property. And one of the things that we've been trying to find, and we haven't really spent a lot of time talking about this, is for increased opportunities to do ag plus. So one of the things that's important for us to be able to generate value to our investors is not to necessarily just own and operate and work these lands, but find ways to have improved, private equity style opportunities. So a great example is if you own, an apple orchard, you can put a facility on place to actually harvest and process those apples and bring them to market rather than just as a raw good, but as a processed good. And this property that we're looking at has that opportunity to build out something on the plus side. So that's something that tends to increase the overall return profile of our overall portfolio. So that's something that is in flight right now, and we hope to look to close on. I guess one other thing I would say is the nature of what we've done historically has been largely in the US, and then by extension by the asset classes. We have some exposure in Brazil, in Chile, in Australia, and New Zealand. But one of the areas that we're also looking is in Europe. And we do have, a specific opportunity that maybe I shouldn't even bring up, but we're looking to diversify the portfolio in Europe, and we do have a couple of properties we're looking at there. So I guess the long-winded point is, we typically have a long pipeline. We're looking to build a globally diverse portfolio. We are looking for, plus opportunities on some of the assets that we're looking at. And we are always trying to diversify across crop style and asset class. Matt, anything specific you wanted to add to that?
No, that's exactly it. I was going to touch on the fact that, we have a global portfolio, York. And so it's not just US centric. And to Alex's point, the European deals and on the table, we're also looking at a deal in New Zealand as well that would fit nicely within a few of our portfolios.
And I guess I have just one more, maybe one question for Ed, in terms that I find interesting amongst your strategies, actually in terms of the healthcare royalty lending, because I think most folks, are probably familiar, by buying, biotech companies in terms of equity side, and obviously that has a huge volatility and drawdown. So maybe you can elaborate a little bit more in your healthcare lending, and maybe you actually are taking advantage of some of the drawdown in the equity market right now.
Yeah, exactly, York. And I think what we do is we sort of provide asset-based solutions to companies that have unencumbered FDA-approved therapeutics on their balance sheet. And so when you think about a company like that, it's a company that's gone through the 10-year process and spent hundreds of millions of dollars to go through the FDA process. They're sort of at commercialization phase, or far along, actually, sometimes more mature in the commercialization phase of their therapeutic. And their funding options, they're not quite mature enough, revenue positive, but not necessarily mature enough to tap the cash flow lending markets. And so their options are kind of more dilutive equity, which, to your point, York, there's been a lot of market volatility in the last year or so, and so that's actually becoming less attractive for them, right? It's more dilutive, and so we can step in and basically offer a non-dilutive asset-based capital solution where we're basically encumbering their therapeutics. And what we do is not only do we typically encumber their therapeutics, we'll also encumber, if they have property or plant equipment on their balance sheet, we'll do that as well, and typically offer a very well covered loan. So the loan to value ratios that we lend at often 25, 30, 35%. So 2 to 3 times covered. And the good thing about sort of this construct is that the cost of equity is very high, right? And so we can come in and structure transactions that's custom, be certainly timely with our closing, but we can also generate returns in the mid-teens, mid-high teens, and that's still actually attractive relative to cost of equity capital.
Okay.
So we are seeing an increased pipeline in that sector. Yeah.
Awesome. So I guess with that, we hit the hour, and I think it's the common theme that I see is definitely lower vol, low correlation, smoother ride, right, than the public market. I think that's one key benefits of all these private assets, to take advantage of various opportunities across the globe. So I think, and I would like to thank all the panelists and all the audience who participated. And I guess if you have any more questions on these strategies, feel free to reach out to your John Hancock Investment Management representative. So with that, have a good afternoon and good evening. Thank you.